equity, we've done 2 readings. So let's move to the third reading, which is market efficiency. Please permit me, if you cannot hear me, please do not fail to interject. Okay, so today we'll be doing market efficiency. So let's jump right into it. So we're going to be doing market efficiency today. Yeah, and that's equity. For market efficiency, just to give you guys, it's not going to be a very long one. Yeah, this is the LOS. So it talks about describe market efficiency and related concepts, including their importance to investment practitioners. Contrast market value and intrinsic value. Explain factors that affect a market's efficiency. Contrast weak form, semi-strong form, and strong form market efficiency. Explain the implication of each form of market efficiency for fundamental analysis, technical analysis, and the choice between active and passive portfolio management. Describe market anomalies, describe behavioral finance, and its potential relevance to understanding market anomalies. So what is market efficiency about? Market efficiency concerns the extent to which market prices incorporate available information. So what do we mean by that? So I just read this out to you guys. So what do we mean by this? What we technically mean by this is that, hold on please. So I just read this out to you guys. So what does this mean? What I've highlighted? So basically, there's a school of thought that the market should reflect all available information about a particular investment, such that information drives prices. And if you think about it logically, it makes a lot of sense. Yeah. So if I want to buy a Samsung phone, for instance, before I buy the Samsung phone, I would have gone to, it would be best for me to understand what that Samsung phone entails. That would sort of drive the value that I would perceive about that phone. So imagine a phone that the camera is not that clear. While you're reading up about that phone, you realize that the camera is 2G. It's not even clear. So, and you go to the market and somebody tells you that you should come and buy that phone for 250,000 naira. The first thing you're going to say is, nah, I'm not going to buy that phone for 250,000 naira. Why? Because I like taking pictures. And for the fact that the phone's camera is not clear, why would I buy that phone for that amount? So what we're just technically saying is that the market, the value you are going to give a particular investment should be driven by the information that you have about that investment. Now, remember that you are not the only person that is interested in that investment. So technically, the value of that investment should reflect all the information or the information that all interested parties would have about that investment, such that that investment should technically should be valued at what we call the true value. So what is the true value of that investment? The true value of that investment should relate to or should be driven by the information that all interested parties will have about that investment. And that is what market efficiency is saying. Do the prices reflect or incorporate all available information? Yeah, that's what market efficiency is all about. Now, the concept of market efficiency, the description of efficient market. So there's something we call informational efficiency. Informational efficiency is an informationally efficient market. Sorry, excuse me. An informationally efficient market is a market in which asset prices reflect information quickly and rationally. And that's what we have here. Yeah. an informationally efficient market talks about two things. One, how quickly information reflects in prices, and are the information rational? Yeah. So, and an efficient market reflects two things: past information and present information. And your present information is based on what? Future information. Yeah. So we are looking at information around three buckets. The past should reflect what you knew prior to now about the investment, should reflect what you know now, should reflect, and what you also know about the future should also reflect. So when you say a market is informationally efficient, it should reflect everything that has to do with information. Yeah. So in this section, we expand on this definition by clarifying time frame required for an asset's price to incorporate information, as well as describing the elements of information releases assumed under market information. Now, what are we trying to say there? Now, what do we mean by quickly? That's the, when people ask me that question, that what do you mean by information should reflect quickly? Information should, when we say quickly, what we mean is at the click of the button. Now, what do I mean by at the click of the button? Everybody, we have what we call information traders, meaning information-driven investors. These are investors that they invest or they trade an instrument based on information. Now, the moment I have an information, either positively or negatively, meaning that positively impacts the investment or negatively impacts the investment, my ability to make use of that information is what we mean by quickly. And quickly means here that the moment I hear an information that would impact an investment, how fast can I make use of it? How fast? And fast here means, am I on a system where all I need to do is click a button and I've taken advantage of that information? Or do I have to call a broker or call somebody before what I can make use of that information? Because what these guys do is make use of information. And that is what we mean by information efficiency. Quickly, how quickly. And I use this, and most times in Nigerian market, I've seen how inefficient, how informationally inefficient that market is. Yeah, because I've seen a situation where an information comes in that you know that that information is positive, and it takes the market a lot of time to reflect or take advantage of that information. Yeah, so right. But basically, that is what we mean by how the quickliness, if that's the right English, how quickly information can reflect in the market or reflect in prices. Now, another aspect of efficiency, market efficiency, that we also need to also consider is the differences between passive investment strategy and active investment strategy. Yeah. Now, for a passive investment strategy, your inherent assumption is that market is efficient, is that prices reflect information quickly. So as a result of that, you take the market prices as the right price. So, and you do not see a room to make abnormal returns. So you take the price that the market gives you as being true and being fairly valued. while an active investment strategy focuses on the fact that, or there's an inherent assumption that the market is inefficient, meaning that the price that the market is giving you does not reflect true in all the information, does not reflect the information that you even have. So, and buying and prices of the market are what? Are not true. So there's room for you to make what? Abnormal returns by buying the stock at the price that the market gives you, knowing fully well that what? The price that the market gives you is what? Is inaccurate. And as long as time passes, the market would what? Reflect its true self. Okay, so that's another aspect of market efficiency. So an efficient market is a market in which I've mentioned this already, in which asset prices reflect information quickly. And like I mentioned, what do we mean by what? Quickly. Quickly has to do with the time frame at which you get that information and you take advantage of that information. So we are very, very particular about something called operational inefficiency, which we will talk about as we move along. Yeah. Finally, an important point is that in an efficient market, prices should be expected to react only to the element of information releases that are not anticipated fully by investors. Now, what do we mean by this? What we mean by this is, so let me explain. Now, what do we mean by this? So all this is assumptions. Yeah. So there's an assumption that investors are rational. There's an assumption that investors consider all available information before they make what? Before they make investment decisions. Before I buy a stock, I consider all available information. That is the concept of rationality. However, or rather, as a result of that, the expectation is that the stock price and the price of an asset has considered all the information that all investors have at that particular point in time. So it is assumed that the market is efficient. It is assumed that all prices, all information have been reflected on price. However, every day new information comes up. New information come out. So as a result of that, what information should you expect to impact prices more? And the curriculum is saying that that should be what? Surprises or unexpected information. And what do we mean by that? Let me explain. As of today, I'll use an analogy. As of today, the expectation is that in no time from now, Dangote refinery will be fully running. That means as of today, the start production commencement of Dangote refinery is already reflecting in Dangote prices. Let us assume that Dangote refinery is listed on the exchange. It's already reflected in prices. Yeah. Now, fast forward tomorrow, and information comes up and says Dangote refinery has been sabotaged, and as a result of that, due to the impact of that sabotage, the refinery will not start until 2026. As that tomorrow, when this information, such an information comes up, that is a surprise. Because as at today, that sort of information was not expected. Because everybody now is expecting that the next thing we're going to hear is that Dangote refinery has commenced, and has commenced at what? Full capacity. But tomorrow, we hear an information that it has been sabotaged. They burnt down an aspect of it due to some mechanical errors, and as a result, Dangote refinery is not going to kickstart in 2026. That would significantly impact prices of stocks, I am very sure, within the oil and gas industry. That's the surprise. And that's what we mean by surprises. So it is surprises that everybody is looking out for. Information that we already know. The expectation is that investors have already what? Put that information in prices. So it is surprise that we look out for. Not just all information, but surprises. Yeah? Okay. So this is an example here. Suppose that a speculative grade bond issuer announces just before bond market open that it will default on an upcoming interest payment. That is a surprise. Now, it might not be a surprise, and I'll explain why. Because some analysts might probably would have done their mathematics or done their analysis and would have probably been postulating that this guy might default, probably based on his financials. Yeah. So to those guys, this might not come out as a surprise. This might come out as a confirmation of what they already expected. You are getting my point? Yeah. So in the announcement, the issuer confirms various reports made in the financial media. You see what I said? Confirms, because it means that such in this kind of situation, there have been traces that this guy is going to default, probably based on industry activities, based on financials, based on people that have been already saying, this guy might default. That's why this guy is now saying that this announcement, in the announcement, the issuer confirms various reports made in financial media in the period leading up to the announcement. Prior to the issuer's announcement, the financial news media reported the following. Suppliers of the company were making delivery only for cash payments, reducing company's liquidity. The issuer's financial condition had probably deteriorated to the point that it lacked the cash to meet an upcoming interest payment. Although public capital markets were closed to the market, to the company, it was negotiating with the bank for a private loan that will permit it to meet its interest payments and continue operations for at least 9 months. If the issuer defaults on the bond, the consensus opinion of analysts is that the bondholders will recover approximately 0.36 to 36 cents to 38 cents per dollar face value. They lost a lot of money. If the market for the bond is efficient, the bond market price is most likely to fully reflect the bond's value after default in a period leading up to the announcement. In the first trade prices after the market opens on the announcement, when the issuer actually misses the payments on the interest payment date. So, guys online, Tosin and Temitayo, what do you guys think?
You are no longer on the screen. Okay, yeah, you are back now.
What do you think? When do you feel the market price of this bond should fully reflect this information? Should it be the period leading to the announcement? Should it be the first trade prices after the market opens on the announcement day, or when the issuer actually misses the payment on the interest payment day?
I will choose B.
You will choose B. Okay, why will you choose B?
So even though A is a probable answer, right? Like period leading up to the announcement. But I want to believe like is when the information actually gets to the market, that's when the market should react, right? So and the the earliest possible period after the announcement is the first day of like is the first trade after the announcement, which is B.
Fantastic. Thank you very much, Temitayo. That answer is correct. The answer is B.
Is
Because,
actually Tosin that spoke, not Tayo.
oh,
Tosin.
Tosin, sorry, apologies. Thank you very much, Tosin. So it should actually be, the answer is actually B. It should be the information comes out and the market reacts immediately after the information comes out. So the first trade that happens on that bond should reflect that default information, that announcement. You're right. If the market, now let me tell you what we call insider trading. Yeah. If the market had reacted before this announcement was made, then it means that some people had this information prior to the announcement and had reacted on it. That is what we call insider trading. Yeah, insider trading. And what will happen afterwards is such an announcement, you will see that people will not react again because people had already reacted. Okay. Number two, if the market for the bond is efficient, the piece of information that bond investors most likely focus on in the issuer's announcement is that the issuer had failed in his negotiation for a bank loan, lacked the cash to meet upcoming interest payments, had been required to make cash payments for supplier delivery. Which information in that announcement was most important? Was it the fact that the bank loan failed? Was it the fact that it lacked the cash to meet upcoming interest payments? Or was it that it has been required to make cash payments for supplier delivery?
Okay. Me, I will go for B sharp.
Is that Tosin?
Yeah.
Temitayo, what will you choose?
I'll go for A.
You will go for A. I'm almost tempted to go with Tosin to go for B. But let's see what the answer is. The answer is A. The failure of the loan negotiation first becomes known in its announcement. The failure implies default. Let's go back to the question. So, that it will default on an upcoming interest payment. Why are you defaulting? Anyway, in the announcement, the issuer confirms various reports made in the financial media in the period leading up. So that means that in fact that the my default was already in the, so yeah, so the answer should be A, was already in the media. Yeah, was already in the media. So probably the reason why they had come up to finally say they wanted to announce is because of that private loan that they did not get. It's all right. So the answer is A. Okay, let's move on. Let's move to market versus intrinsic value. So what is market value? Market value. What is market value? Market value is the price at which an asset is either bought or sold. It is the price that the market is saying is the value of that asset. That is what market price is. However, this is different from intrinsic value. And sometimes intrinsic value is also called fundamental value. Now, the curriculum is saying your intrinsic value, broadly speaking, is the value that will be placed on it by investors if they had a complete understanding of the asset's investment characteristics. I will put it differently. Your intrinsic value is the value that you place on that asset, given the information that you have about that asset. And if the information that you have is complete, then you can say that that intrinsic value is the real value or the true value of the asset. Now, another thing again I tell people is your intrinsic value is personified. Now, what do I mean by personified? The value I will give Zenith Bank will be different from the value that Temitayo will give Zenith Bank. It's different from the value that Tosin would give Zenith Bank. Three of us most likely will not give Zenith Bank the same value. It's not possible. We will not give Zenith Bank the same value. We will give Zenith Bank different values. And that's how it works. Now, it is now what we give, what value, the intrinsic value that we give Zenith Bank or the asset vis-a-vis the market value that help us to determine if we are going to buy an asset or not buy an asset. So I like to say this. Imagine I want to sell a car, a Benz Jeep. And I tell you that the Benz Jeep is 2 million naira and it's 10 million naira, hypothetically. And I offer you to Tosi and Temitayo to say, both of you come and buy this Benz Jeep for 10 million naira. Yeah? Temitayo will bring his mechanic. Him and his mechanic will drive the car. They will drive the car, they will analyze the car, they will do everything, you know. Because I will not give you any information. I'll just tell you the car is for sale. Then Temitayo's mechanic comes and says, come on, the gearbox of this car, let's say you don't go. That 10 million naira, you know, go chop. Tell the guy say you go buy for 8. Now, that 10 million naira is the market price. The 8 million naira that your mechanic said you should give is your intrinsic value. Yeah, it's your intrinsic value. Now, one thing must happen. The market price must come down to 8 million naira before Temitayo can buy. If the price does not come to 8 million naira, Temitayo is not going to buy. So if Ahmed says, if I say no, 10 million naira is 10 million naira, I am not coming down to 8 million naira. Then what would Temitayo do? Temitayo say he's not buying. He walks away. Tosin comes with his mechanic. You can see what happened. Temitayo's mechanic said, gearbox don't go. Pay 8 million naira. Tosin comes with his mechanic. Him and his mechanic drive the car. They drive the car on the Bagada Expressway, turn round, hey, enter Terminal Bridge, flow, come back. Tosin's mechanic says, bros, this Benz na Atalanta, na 12 million naira supposed to buy this Benz. See, this 10 million naira which this guy will offer you is better, it's cheap. Na cheap price. What does Tosin do? Tosin say, to make I beat them down to 9.5. If you beat them for 9.5, try you. For me, I tell you say this 10 million naira. Na good one. Tosin calls me and says, bros, how far? That car, if you pay 9.5, I tell him no, 10 million naira last. What happens? Tosin buys it. Now, you see what has happened? Tosin's mechanic has given Tosin an information that makes Tosin to conclude that the Benz Jeep values more than 10 naira. It values at 12 naira. Sorry, 12 million than 10 million naira. So to Tosin, that Jeep, that 10 million naira that has been priced onto that Jeep is cheap based on the information that he has or that was given to him. And that's which is what had made him make that conclusion to say, you know what, I will buy it. Now, the point I am trying to say here is, to Temitayo, his intrinsic value was significantly different from Tosin's intrinsic value, was even different from my own intrinsic value, which automatically became the market price. So the point is, at every point in time, for a market, for a stock or an asset that trades in the market, investors are consistently analyzing the information available to them about that asset and comparing it to the market price to determine if they should either buy or sell that asset. So at every point in time, intrinsic value and market value is what? Is always what? Is always being compared. Such that if the intrinsic value is higher than the market value, you buy the stock. And if intrinsic value is lower than market value, you sell the stock. Let me say that again. If intrinsic value is higher than market value, you buy the stock. And if intrinsic value is lower than market value, you sell the stock. Yeah. So that is market value versus intrinsic value. Now, example. Now, let me go back again, yeah, which answers this question that I gave. Remember when I said if intrinsic value is greater than market value, you buy the stock. You buy the stock because the stock is undervalued. That means the market is valuing that stock at a price that is lower than the intrinsic value. Now, if the intrinsic value is less than the market value, you sell because the asset is what? Overvalued, meaning that the market is giving that asset a price that is more than is what? Is true value. So you sell. So you buy undervalued stocks or assets and sell overvalued assets. Undervalued assets is when intrinsic value is greater than market value. Overvalued assets is when intrinsic value is less than what? Market value. So in this answer, your intrinsic value is lower than market value. So the answer is what? Is overvalued. Number two, a market in which asset values are on average equal to or nearly equal to intrinsic value is best described as a market that is attractive for passive investors. The answer to that is passive investors. So when on an average prices are fairly valued, it is a market where passive investors operate because they assume that such a situation can only arise if the market is what? Efficient. Remember, it is passive investors that like what? That like efficient markets, while inefficient markets are liked by active investors. So the answer to this is B. Now, number three, suppose that future cash flows of an asset are accurately estimated. The asset trades in a market that you believe is efficient based on most evidence. But your estimate on the asset's intrinsic value exceeds the asset's market value by a moderate amount. The most likely conclusion is that you have. What do you guys think? I want you guys to answer this one. Overestimated asset risk, underestimated asset risk, identified a market inefficient.
Overestimated the asset risk.
You overestimated. Okay. Who is that? Is that Temitayo?
Tosin.
Hello. Okay, that's Tosin. Temitayo, what's your answer?
I
Or
think
do you agree with Tosin?
I'm not sure to be honest, but I think I think if the intrinsic value exceeds the market value, then that means um, there's a bit of something that is not properly analyzed. More or less like the value of the asset is underestimated. That's why not the value of the asset. Like I think the asset risk is underestimated. That's what I would think. Based on what you told us earlier, because you said if the intrinsic value is greater than the market value, we should buy. So that means, and from this place, if the asset market, sorry, if the intrinsic value here exceed, even though the amount is moderate by a moderate amount, I won't think it's overestimated the asset risk. That's what I think. I don't know if I'm making sense, honestly.
You are making sense. You've made a lot of sense. I would also go with B. Yeah, I will also go with B. Because if you look at what they're trying to say here, naturally, this asset should be, the market is efficient. That means the asset should be fairly valued. Yeah. Now, you now did your own calculation and you are seeing that your intrinsic value is a bit higher than the market value. Then it means that you must have underestimated a particular risk. Yeah, you must have underestimated a particular risk. You know, and another way to look at it is that if you have done, which I don't know if you guys have done that, but if you look at the present value computation, yeah. So if you are looking at your future cash flows and you are trying to discount your future cash flows present, the discount factor carries your perceived risk. So and there's an inverse relationship between value and the discount factor, which carries risk. So if my discount factor is high, then it means that what? My value is low. And if my discount factor is low, then it means my value is high. So that means for me to have a value that is higher than what it should naturally be, then it means that my discount factor is low. That means I must have underestimated the discount factor.
Mr. Med.
Yeah?
Hello? Yeah.
Yeah, Michu,
Okay,
can you hear
so
me?
yeah, I can hear you. So what you just explained, now is you explaining that risk is inversely related to returns, right?
Sorry? Come again.
I said what you just explained now is you saying that risk is inversely related to return.
No, risk is directly related to return.
Okay, sorry, directly related. Like
And
the higher the risk,
inversely related to value.
Okay. So if it's directly related to return, right? Does it not mean that it is when you overestimate risks, like when the risk is high, that's when we
Return
are
is
talking
high.
about value here.
We are talking about value here, not return.
Oh, I see. I get it now.
Fantastic.
We are talking about value here, not return.
Value, not return.
Yeah, that's fine. It's clear.
It's clear now, yeah?
Yeah.
Okay, moving on. Factors affecting market efficiency, including trading costs. So, what are the factors that makes the market? So, what are the factors that affect or impede market efficiency? I think that's what we should talk about. What are the factors that impede or drive efficiency? For markets to be efficient, prices should adjust quickly and rationally to the release of new information. That's everything I have been preaching. In other words, prices of assets in an efficient market should fully reflect all information. Financial markets, however, are generally not classified at the two extremes. I like this a lot. Yeah. Sorry, I'm reading from the curriculum. Yeah. Financial markets financial markets, however, are generally not classified at the two extremes, at either completely inefficient or completely efficient, but rather at exhibiting various degrees of efficiency. So that means what we always say is that we never say a market is inefficient or a market is not or is efficient. We always speak to it as level of degree. Yeah. In other words, market efficiency should be viewed as falling on a continuum between extremes of complete efficiency at one end and completely inefficient at the other end. This degree of efficiency also varies through time across the geopolitical market and type of market. A number of factors contribute to and impede the degree of efficiency in the financial market. That means two markets can never be the same. The fixed income market and the equity market cannot be the same, even though they are both in Nigeria. Do you understand? Some might, the American market and the Nigerian market would have their two levels, different degrees of what? Of efficiency. You are getting my point? And this efficiency is like correlation, yeah? It moves from the minus to the plus, 1 or -1. So we operate within that degree of inefficient to what? Efficiency. Yeah? So the first factor that affects efficiency is market participants. And for me, I look at market participants from two angles: the number of market participants and how knowledgeable the market participants are. So it's not just by having large number of market participants, because it's good. You know, there's a thing that they always say is that the more players, the more the price of that asset tends to what? To efficiency. The more efficient the price of that market is, because let me tell you why. Imagine if Temitayo is the only person that is buying an asset. That means that asset most likely will be efficient. Why? Because it is only the information that Tosin knows that that asset will be reflecting. However, imagine if there are 1,000 people that are participating in this asset. All of them might not have, there's some information that everybody will have. There's some information that only 20 people will have. There's some information that only one person will have. There's some information that only 200 people will have. And what happens? The moment those guys get that information, what do? They reflect it in price quickly. So, and the more participants that you have, the more people that are getting and sourcing information pertaining to this asset, the likelihood that that asset will be tending towards what? Efficiency. Yeah.
Sorry, sir. Can you hear me?
Yeah, I can hear you loud and clear.
Okay. So I wanted to say that from what you just explained, right? Does it mean that I'm thinking of how to ask that question? Does it mean that even if an information is available in the market, right? Like a data is available in the market, but the access to that information, like there is like a barrier to access. When I mean like a barrier to access, for example, maybe if you are not in a particular circle, right, you might not hear some type of information which is going to inform your own decision, right? Does those type of factors, right, does it determine efficiency of the market? Do you get my question?
Yes. It's almost the same thing I was saying as market participants. So what you have done is you have led to your market has led to what we call segregation of information. Yeah, I don't want to call it information asymmetry, but information asymmetry is when it's only one side of the trade that has the information. But this is what you have said is information segregation, meaning it is only a selected few that have access to that information. And what you have said is what I feel happens in the Nigerian Stock Exchange. It's what happens in the Nigerian Stock Exchange. Brokers tend to have more information about what is happening in that market than any other person that is not a broker. I have
Okay,
been
so
in that
Mr.
market.
Ahmed, you know what I
I'm
think?
with you.
So I think that it's not like that information is not available. It's there, right? But the way, because of technological advancements, like in our own Nigerian case here, in our own economy here, right? Information might not like, it's not easily
Might not spread.
dispersed. Not like,
Might not
yeah, might
spread.
not spread like, do you get the spread of information is not like it happens. So you might just be getting an information today, whereas that information has been maybe since last 2 weeks.
Ross, Tosin,
Yeah.
let me give you a story. I used to be a broker. Yeah, let me give you a story. And I like to say this story a lot. Yeah. MTN came to the market in 2018, if I'm not mistaken. They got listed. And in their roadshow, that was the first time they ever mentioned to us that they wanted to start a payment service bank. Yeah, PSB. And considering the fact that we all knew who MTN was, meaning that MTN is a cash cow, it's a cash cow business. Yeah, we're all excited to say, that would spoil the market, that would spoil the banking industry. They will take cheese from banking industry's trap and all that. 2019, nothing. 2020, nothing. 2021, an information came out and said they had gotten provisional approval. The market reacted. Yeah. No, was it? No. It wasn't. No, it was the provisional approval. Yes. So the market came. The information was released on a Friday morning that MTN has now secured central bank's provisional approval for their PSB license. Now, Tosin, how do you expect the market to react at the point of open, considering that we are learning market efficiency today? Hello, Tosin, are you there?
Yeah, I'm with you. So how do I expect the market to react, right?
To react.
I expect the market to react slightly, like the elasticity of that reaction. There will be a reaction, but it won't be so that much. Right? The reason why I'm saying that is because that information is expected, like it has been expected before, and before that time. They've said it before that they are going to get a PSB license, right? And because they've said it before, the market would have also reacted at that point. But at that point when it is now live, like it becomes activated, they actually release the news that they got the PSB license, right? The market will react again. But I'm saying that the reaction will not be that much, like as if they are saying it for the first time.
Okay, so I like that. Yeah. Let's keep it simple to the market reacts positively. Yeah. Now, what happens? 10 o'clock, market resumes. The market did not react. For the whole Friday, the market did not react. My colleague calls me, the broker calls me and says, "Bros, what do you think? Should we buy?" And I said, "Buy." And the guy bought. On Monday, the market reacted 10%. Tuesday, 10%. Wednesday, 10%. Now, the point I'm trying to drive out here is the market ended up reacting, but the market was slow to reaction. Yeah. Now, was the market efficient? I would say no. You are getting my point. It has a low degree of, it was efficient, but a low degree of efficiency. If it was that the market never reacted, then you would say, oh, the market is inefficient. But the market was slow to react. which is what leads to your point, which is how does the information go out? How do people source for information? Some people might have a higher level of ability to source that information than some other people. Yeah. How does that information spread? And I'll be honest with you, yeah. In the last couple of months, years, that information spread has improved significantly. So I'll typically ask you a question now. I'm sure everybody on this call is aware that CBN wants to recapitalize, and they've sent out a communique on it. It is everywhere, and that is how efficient in terms. No, I won't say efficient. How the level at which information dissemination has increased over couple of years. Social media has really helped a lot. Yeah, compared to, I would say, maybe compared to prior to COVID. So I'm also likening it to COVID because it seems COVID sort of opened our eyes to the fact that we really need information. I've seen that improvement since after COVID. Prior to COVID. So for me, that is also a factor, which I believe is one of the factors that you are going to see here. But at this point, we're mostly talking about availability of market participants and how knowledgeable the market participants are. So the higher the number of market participants, the higher the level of knowledge of that market participant, the more efficient the market is going to be. Yeah. So the next factor is availability of. So this leads to what you are talking about: availability of information and financial disclosures. Do the companies disclose? Do the companies tell us and make this announcement? The answer to that is yes. If they do, how do they do it? Do they make the information available to everybody? You are getting the point. So for me, it is the availability of that information, the disclosure of that information, how the information spreads will also drive your market to efficiency. The day MPR was increased, it was everywhere. The day the central bank said they were recapitalizing banks, it was everywhere. The day the central bank said they will start giving BDCs $10,000 every week, every day, every month, I can't remember the frequency. It was everywhere. And in the moment that information gets everywhere, the market is reacting. The market is reacting. See the way dollar has crashed in the last couple of weeks because information is everywhere. That is the kind of information apologies that we did not have during Emefiele. Information everywhere. Yeah. So that's the higher the availability. Can you see? E.g., active financial news media. Nairametrics is trying. Arise is trying. Everybody is there pushing out that information. Yeah. And the more the information gets out there, the more the market tends to efficiency. Limits to trading. Limits to trading. Are there policies? Are there rules that limit your ability to express yourself in the market? Arbitrage is a set of transactions that produces riskless profits. Arbitragers are traders who engage in such trades to benefit from price discrepancies. Do you allow, can you see, such trading activities contribute to what? Market efficiency. Do you allow for arbitrage? When the central bank governor said he's going to eliminate arbitrage in the FX market, I laughed. I said, it means that what? There's problem. If you want to eliminate arbitrage from the market, then it means that what? You want to control prices. Because if you don't want to control prices, then you have to give room for people to speculate, give people to arbitrage. The Nigerian Stock Exchange does not allow for short selling. So if I see a bad company, I cannot short sell. I can't take advantage of it. All I can do is what? Avoid the company. However, I should be able to short sell. In 2020, did you guys hear about this? I was watching a movie yesterday. Did you guys hear the story about a company called a stock called GameStop in America? That company is one of the most short sold stock in the American Stock Exchange. However, in 2020, what happened? Retail investors came and took that stock to the moon. That was when the first head to the moon. Bitcoin to the moon. GameStop to the moon. And what happened to all the short sellers? They lost their money. But the truth be told is, the retail investors, did they know what they were doing? No, they didn't know. They were just having fun. To the moon, to the moon, to the moon. You know, and there was free money all over the whole place during the COVID. They're giving everybody free money. So a lot of people had free money and they're putting it into the stock. So when we mean limits to trading, we're saying is the market in a place where people are allowed to express their views about a stock. If I have positive views, I buy the stock. If I have negative views, I short the stock. Yeah. So with that, those are another thing again that impedes or contributes to market efficiency. The higher the limits, the more inefficient the stock market will be, or the market will be. Now, another thing again that also relates to what Tosin said is transaction cost and information acquisition cost. Transaction cost means I pay a fee to buy stocks. I pay a fee to sell stocks. If the transaction costs are high, I might be reluctant to take advantage of the information that I have. If I don't have a strong conviction about the information and the impact of the information to the stock, because I know that there's going to be transaction costs, I might end up not taking advantage of the information. So transaction cost significantly impedes market efficiency. Information acquisition costs are costs that you incur in order to source for or gather information. A typical example is everybody uses Bloomberg. Bloomberg is very apt at getting top-notch information, but the cost of getting Bloomberg is off the roof. The cost of getting Bloomberg is off the roof. So, if your information acquisition cost is high, then I might be reluctant to be an active portfolio manager. I might be reluctant to source for such information. I rather stick to the fact that the market is efficient and the market is giving me the right price. Who is speaking? You can go ahead.
Okay, so it was the Bloomberg you mentioned that actually triggered me. Right? Like I'm always curious. Bloomberg is not like a locally. It's not a local organization, right? Which is not domiciled in Nigeria. But I see that the information released on Bloomberg, they are almost real time. Like as it hot, that is how they drop it. So, yeah. So I'm curious, how do they get their own information too? Like they are not domiciled in Nigeria. It's not local.
My brother, now only God know that one. I will not lie to you. I wish I can answer that question for you, but I can't. Because I've also asked that question to say, how do they get their own information? I have a feeling that they have what's that word? They have what they call those people? Agents. Will you call them agents? They have information gathering officers everywhere. And they've been able to be identify those people that they can probably reach out to and have agreements with, such that anytime there's a particular information that they know that will be beneficial to Bloomberg, those guys will share the information to them. That's what I feel they do. But I'll be honest, how do they go to the information? I really cannot say. I'll not lie to you. I really cannot say.
But the thing is just, it's always amazing me. Like Bloomberg is like a shop all. It's like a one stop for everything. Just go there.
Yep.
You will see
And
it.
you get all the information that you want.
Yeah. But it's fine.
Okay. In summary, I always like when the curriculum gives us summary. In summary, a modern perspective calls for investors to consider transaction cost and information acquisition cost when evaluating the efficiency of a market. A price discrepancy must be sufficiently large to leave the investor with a profit adjusted for risk after taking account of transaction cost and information acquisition cost, to reach the conclusion that the discrepancy may represent market inefficiency. Prices may somewhat less than fully reflect available information without there being a true market opportunity for active investors. What do they mean here? A price, a stock or an asset might be mispriced. And the reason why that asset is mispriced is because transaction costs and information costs are high. So everybody has that information, but nobody is taking advantage of it, because by the time they look at the price, the profit they are going to make from taking on that investment, the cost that they will incur or they would incur to get the available information, they do what? Like I said before, they let it go. So that discrepancy is because of this cost that we're just talking about. Yeah. So it's like cost and benefit analysis. What is the cost to me and what is the benefit to me? Okay, moving on. Forms of market efficiency. Forms of market efficiency. There's a man called Eugene Farmer. He was the one that developed a framework for describing the degree to which markets are efficient. In his efficient market hypothesis, markets are efficient when prices reflect all relevant information at a point in time. Keyword, at a point in time. This means that market prices observed for securities, for example, reflect information available at that time. You're getting my point? So what are the information available at that point in time? Is the price reflecting it? In their own words, price is reflecting it already. Anything, any information, price is reflecting that at that point in time. Anyway, they said the three forms of efficiency are the weak form, the semi-strong form, and the strong form. The weak form, the semi-strong form, and the strong form. Each form is defined with respect to the available information that is reflected in prices. Now, they gave us this table, and this table sort of summarizes everything, to be honest. In a weak form of market efficiency, the only thing that is reflected in price are past market data. Yeah, past market data. So it is only what has happened in the past that is reflecting in price. It's only what has happened in the past that people have information about. Yeah, and it is what is reflected in the price. Now, for your semi-strong form, they say that for semi-strong form, market prices reflect both past market data and public information. As long as the information is public, it is assumed that what it is already reflected in prices. And also, market data of the past is also reflected in prices. So you would say that the semi-strong form is an advanced form of what? The weak form. So the semi-strong form is an advanced form of the weak form. Yeah. Then you now have the strong form of market efficiency, which covers three things. Market prices reflect past market data, public information, and private information. Yeah. It is an advanced form of what? Of the two forms of semi-strong and weak form. Yeah. So it is an advanced form of semi-strong, and the semi-strong is an advanced form of what? Weak form. Yeah. So, and what these guys are saying, or what this man is saying, is that information, all information is reflected in price. And those information comes across past market data, public information, and private information. If such a case exists, then we call it the strong form of market efficiency. The strong form of market efficiency. The strong form of market efficiency. So that is a summary of everything that they have said here. Now, what they also said is that if you look at each of these forms, it shows you the kind of information that is existent in each of these forms. Yeah. And it also tells you, remember, that the whole essence of being an active portfolio manager is to be able to carry on the active investment strategy, is to look for ways to benefit from every market, considering the degree or the form of the what of efficiency in that market. So what they are saying now is that if you look at the weak form of market efficiency that already incorporates past market data, then using technical analysis in that market would be what? Would be a waste of time. Why? Because past data is already reflected in the market. And also, technical analysis is a form of analysis that takes what? Prevalence in what? In analyzing what? Past data. So it means that if you are going to analyze past data to make investment information, you are wasting your time, because past data, past market data is already incorporated in what? In the market. Now, moving on to semi-strong. Because in the semi-strong, public information is already reflecting in market price. And as an active portfolio manager, you want to look for a way to extract value from that market. The curriculum is saying that fundamental analysis would be a waste of time. Making use of fundamental analysis would be a waste of time. Please, if you are not speaking, can you mute Mr. Joseph? Thank you. So, let me start that again. Moving on to semi-strong form. Semi-strong form incorporates past data and public information. Because past data is already reflecting in semi-strong form, so that means you cannot even use technical analysis. Another analysis that you might want to use is fundamental analysis. But fundamental analysis makes use of what? public information. And because public information is already reflected in semi-strong form, so it means that making use of fundamental analysis also, if the market is semi-strong, is what? Is a waste of time. So, and in the semi-strong form, there's no, if you identify a market to be semi-strong, efficient, then there's no need to make use of what? Technical analysis and what? Fundamental analysis. Because market has already reflected past data and public information. The last is the strong form. Strong form incorporates past data, public information, private information. Past market information is already reflected. There's no use to make use of technical analysis. Public information is already reflected. There's no use making use of what? Fundamental analysis. Now, let us now move to private information. If I have private information, then it means I can do what? Insider trading. That is the only way I can make abnormal returns. But strong form is also saying that private information is already reflecting. So, and you can't also do insider trading in a strong form, efficient market. Because market has reflected all types of information. So it will be a waste of time. So technically, what we are saying here is, if a market is in a weak form, for you to make money, you can use what? Fundamental analysis and insider trading. But you can't make use of technical analysis. In a semi-strong form, you can make use of insider information, but you can't make use of fundamental analysis and technical analysis. While in a strong form, you cannot make use of anything because market is superly efficient. Everything is reflected in market. Yeah. Okay. Any questions? Any questions? Any questions for me?
I thought insider trading is not legal.
But some people still make use of it. Some people still make use of it. So what I just trying to tell you is that don't waste your time trying to get insider information in a strong form, in a strong form market. There's some people that still make use of insider trading. It's all about being caught. Yeah, Mr. Tosin. It's all about being caught. Now, I've also done implication of efficient market hypothesis. Yeah, which is what I've mentioned now. Yeah, so I've explained these two. Fundamental analysis, you can't make use of fundamental analysis. You can make use of fundamentals in a weak form. You can't make use of technical analysis in any of the forms. So what I'm just trying to say is that technical analysis is a waste of time. Yeah. For the portfolio manager, your level of the form of the market will technically tell you what strategy you should use. Should you be a passive investor or should you be an active investor? So technically, you can still be a passive investor. You can still be an active investor if the market is semi-strong. No, if the market is weak, because if the market is semi-strong, we'll be most likely making use of insider information, which is not legal. Yeah. So it's only in a weak form where you make use of fundamental analysis. But what I'm just trying to say is that it's good for you to know the level of efficiency in that market for you to be able to determine the investment strategy that you want to adopt as a portfolio manager. Yeah. Okay. Now, moving on to market price anomalies, time series, and cross-sectional. I'm thinking we should take a 30-minute break and we will resume at 11:30. Let's have a 30-minute break and resume. 13 minutes break and resume at 11:30. Okay, I'm back. Let's continue. Are you guys there? Tosin Temitayo, are you there?
Yeah, I'm here.
Okay.
Yes, I can hear you.
Market. Sorry. Okay. Market pricing anomalies, time series, and cross-sectional. Although considerable evidence show that markets are efficient, researchers have identified a number of apparent market inefficiencies or anomalies. Now, what are we trying to say? What do we mean by anomaly? Yeah. Researchers conclude that a market anomaly may be present if a change in price of an asset may be present if a change in price of an asset or security cannot directly be linked to current relevant information known in the market or to the release of a new information into that market. So what are we trying to say? When the prices of an asset moves, but we cannot attribute that movement to any factor or to any information. Yeah, or new information or any information, the market price just moves. Then we could call that price movement a what? An anomaly. Yeah. So what we're saying is prices must always move as a result of information. But when prices move without anything attributable to information or a new information, then we call that an anomaly. So the validity of any evidence supporting the potential existence of a market inefficiency or anomaly must be consistent over reasonable long periods. Otherwise, a detected market anomaly may largely be an artifact of the sample period chosen. In the widespread search for discovering profitable anomalies, many findings would simply be the product of a process called data mining or data snooping. Yeah, so people are just playing around with data. Okay, so we have two types of anomalies. So we have time series anomaly and cross-sectional anomalies. Time series anomaly is over time. Yeah, so these are anomalies that occur. We have seen them happen over time. Yeah, while cross-sectional anomaly is at a point in time. So we have seen them happen at a point in time. So under time series anomaly, we have January effect. That happens even in Nigeria. So January effect is, we notice that for a significant percentage of the time, the market is always positive in January. So don't stress yourself. Just enter the market in January. By the end of January, you have made money. Yeah, so that's January effect. And the reason why there's a January effect is because market participants are taking positions. So there's a lot of buying and selling and buying that happens during that month. Then day of the week anomaly. So we've noticed that the market is relatively always quiet on Fridays and very active on Mondays. So quiet on Fridays because everybody's tired, everybody just wants to go and do TGIF and go for the weekend. Mondays because there's been a Saturday and Sunday that has given people room to evaluate their positions, and they come into the market on Monday to take on their positions. So most of the time, the market is always active on a Monday and calm on a Friday. Then the weekend effect. That's what literally almost the same thing as the Friday effect, leading up to Friday. Then turn of the month effect. The market is always, we've seen an evidence that the market is always positive at the beginning of the month. Then holiday effect. Days leading up to the holiday or days after the holiday, the market tends to be very, very quiet. Time of the day, this one happens a lot of time. Yeah, the market is always active during the first 1 hour to 2 hours of the day and the last 1 hour of the day. Yeah, that's when the market is always active. And when I mean active, the direction of the market will present itself during those periods of activeness. So if the market is going to be negative, you would see most likely the market will be negative during the first 2 hours of the day and the last 1 hour of the day. Then momentum. Momentum is related to the direction of the market. We have seen that most times stocks that are in the positive will always continue to be in the positive, and stocks that are in the negative will continue to always be in the negative. We'll see that happen. We've also seen that happen over time. Then overreaction. This cannot be overemphasized. There is also evidence that market participants overreact to the information. They overreact to information in the market. So we have the calendar anomalies. So time series, majority of them are calendar anomalies, while the others are momentum and overreaction. So calendar has to do with date and time. Yeah, so the January effect, the turn of the year effect. You have also the others I have mentioned, which is the day of the week. Yeah, then weekend effect, holiday. The markets tend to overreact. Market participants tend to overreact. Now let's go to cross-sectional anomalies, the size effect and the value effect. So the size effect is that we have noticed that small cap stocks always do better than large cap stocks. Yeah, small cap stocks do better than large cap stocks. And for me, it's just logical. Yeah, a small cap stock that is 2 naira gains 50 kobo, and a large cap stock that is 100 naira and gains 50 kobo. Yeah, the small cap guy would have returned a percentage that is higher than the large cap stock. Yeah, and we've seen this happen over and over again. Then the next is the value effect, which is where we say growth stocks or value stocks tend to do better than growth stocks. Yeah, the Farmer and Friends 3-factor model brought a lot of this value and size effects to life. Yeah, now moving to other anomalies. Closed-end investment fund discounts. I've mentioned that to you guys when I taught you guys portfolio management, mutual funds. So closed-end funds tend to be sold at either a discount or a premium. And the reason why is because of the fact that it's part of liquidity. Yeah, it's a liquidity. I believe it's a liquidity-driven factor or reason for the premium and the discount. So it's liquidity that is driving that discount or premium. The fact that people cannot easily exit or enter. Yeah, so people would be willing to. So you can see here, liquidate the fund. Your inability to liquidate the fund or purchase the fund is the reason for this anomaly. Yeah. Okay. Then the next one is any surprise. So what do we mean by any surprise? So there are some people that all they do is wait for the companies to do what? To declare their earnings, and they react. So what we have noticed is most times when companies declare a surprise to what market participants have sort of expected, then market will sort of react. But I have a contrary opinion to this, to say the any surprise in itself is an information. So I wonder how that is driving an anomaly. Yeah, because market participants are just reacting to it. Now, an initial public offer. Yeah, there's also I like this. I always call it the IPO profit, the IPO run. Yeah. So when a company, and you can check it on Gerebu, no, not Gerebu, which company just got listed? Transpower. Go and check Transpower, you see it, the price of Transpower. So what we have noticed is that when stocks get listed on the exchange, the price of that stock rally for the first 3 to 5 days, which is the anomaly. And what is causing that rally is because people that did not have access to buy the shares during the IPO exercise tend to come to the market to aggressively buy the stocks and move the price of the stocks up when the company now eventually launches or gets listed on the exchange. So that's what we call the IPO anomaly. So the curriculum says practicability of returns based on prior information. A number of researchers have documented that equity returns are related to prior information on such factors as interest rates, inflation rate, stock volatility, and dividend yield. But finding that equity returns are affected by changes in economic fundamental is not evidence of market inefficiency and will not result in abnormal trading returns. Furthermore, the relationship between stock returns and the prior information is not consistent over time. For example, in one study, the relationship between stock prices and dividend yield changed from positive to negative in different periods. And a trading strategy based on dividend yield would not yield consistent abnormal returns. Implication for investment strategies. Although it is interesting to consider the anomalies just described, attempting to benefit from them in practice is not easy. In fact, some researchers conclude that observed anomalies are not valuation of market efficiency, but rather are the result of statistical methodologies used in detecting anomalies. Can you take advantage of anomalies? My answer to that is yes. You can. At least you can take advantage of general effect. Yeah, it's just that the probability of it happening is not certain, meaning that there's still a probability. It's not a certainty that you buy stocks in January 1st and you end the year in profit. Now, let's move to behavioral finance. Now, in some quarters, they've said that behavioral finance is a field that helps us to understand market anomalies. Yeah. So behavioral finance examines investors' behavior to understand how people make decisions individual and collectively. So how do you make investment decisions individually and collectively? Behavioral finance does not assume that people consider, remember what I said, that people consider all information before they make that investment decision. Well, behavioral finance says that people do not do that. That investors are irrational. They do not consider all available information before making that investment decision, and act rationally by maximizing utility within budget constraints and updating expectations consistent with base formula, meaning that there's something we call satisficing, yeah, which is you make your decisions based on your area of, I don't say your area of circumference, but based on your conditions. So you always make your investment decision based on your conditions. You don't make investment decisions based on all available information. And that's what behavioral finance is trying to sort of study. How do you make that investment decision? Are investors really rational? Now, they're saying that there are different behavioral biases that investors exhibit. So investors exhibit behavioral biases that sort of distort the way they make decisions. A typical example is one, loss aversion. In this class, I had mentioned to you guys that investors are risk averse, meaning that they tend to what? Dislike risk and look for what? Look for investment that gives them what? Certain returns. However, the curriculum is saying that no, behavioral finance is saying that no, investors are loss averse. They run away from loss. They do not run away from risk. They run away from loss. Investors dislike loss. So investors have a tendency of relating risk to loss. So rather than them understanding that risk is the fact that your investment is going to what? Is going to fluctuate over your investment period. Rather, they take risk as what? The probability or the fact that you are going to lose money. So, and when they hear risk, they run away from it because they automatically tend to think that it is what? It is loss. You're going to read that. There's a reading on a course on behavioral finance that you are going to see. During my time, it was a level 3, but recently I remember somebody telling me that it's no more in level 3, probably it's now in level 2 or level 1 or so. But then there's something called edging. You guys must have heard it. Edging mentality. MMM. You know, for me, MMM was driven by a behavioral bias called edging. The edging behavior. Follow mentality. Yeah. The edging behavior has been advanced as a possible explanation for underreaction and overreaction in the financial market. All edging occurs when investors trade on the same side of the market in the same securities, or when investors ignore their own private information or analysis and act as other investors do. You have analyzed the market. You have done your own analysis, or you go and ask Temitayo and Tosin. Tosin, what are you thinking? Tosin and Temitayo will tell you what they are doing. And bam, your own analysis is thrown into the dustbin. It's Tosin and Temitayo's analysis you are going to follow. That is what we call edging. Edging significantly impacts your investment decision. Overconfidence, you can never run away from this. Yeah, a behavioral bias offered to explain pricing anomaly is overconfidence. If investors are overconfident, they overestimate their ability to process and interpret information about security. You do not calm down, you are overconfident. So rather than you doing proper analysis to determine the intrinsic value, what do you say? I don't drive Benz before now, I'm not the best. I don't do this. I've seen myself in this situation before and I know how to navigate it. And whatever I did before is what I'm going to do now, because the last time I made that decision, I came out topped. Baba, sit down and do your analysis. Forget what you are, and that is breathing what? Overconfidence all over the place. Now, we have what we call information cascade. Information cascade. Biases that investors possess can lead to edging behavior or information cascade. Edging and information cascade are related but not identical concepts. And information cascade is the transmission of information from those participants who act first and whose decision influence the decision of others. Those who are acting on the choices of others may be ignoring their own preferences in favor of imitating the choices of others. In particular, information cascades may occur with respect to the release of accounting information, because accounting information may be difficult to interpret and may be noisy. For example, the release of earnings is difficult to interpret because it is necessary to understand how the number was arrived at, and noisy because it is uncertain what the current earnings imply about future earnings. So what we're saying here is information cascade means some people are the ones doing the analysis, and by the time they communicate that analysis to the people that will make decisions, the people that will make decisions do not properly understand the information that is passed and to or ignore their own analysis and go ahead to take. So this happens when you are in a world where you have research guys that do your what, that do your analysis for you, and you are making decisions based on what those research guys are doing. Okay, other behavioral biases, representativeness. Investors assess new information and probabilities of outcomes based on similarities to the current state or their familiar classification. Yeah, they are using what you know to make what decisions, not on interpreting and analyzing the information that has come to you. Then we have mental accounting. When you what? When you deal information based off or by segmenting information, mentally segmenting information to be able to what? To make the information, rather than you forgetting that what information must be dealt with as whole. Conservativeness, your inability to what? To adjust, or you are slow to react to what? To new information or changes in what? In forecast. Narrow framing. Investors focus on issues in isolation and respond to issues based on how the issues are posed. So behavioral finance and investors, yeah, very significant. Behavioral biases affect investors in how they make their work, in how they make their investment decisions. An understanding of behavioral finance can help market participants recognize their own and other people's biases, such that it helps you to make informed investment decisions. While behavioral finance and efficient market, the use of behavioral finance to explain observed pricing is an important part of understanding how market functions and how prices are determined. Whether there's a behavioral explanation for market anomalies remains a debate. Pricing anomalies are continually being uncovered, and then statistical and behavioral explanations are offered to explain these examples. On the one hand, if investors must be rational for efficient markets to exist, then all the imperfections of human investors subject that market cannot be efficient. Meaning, what they are saying there is, as long as behavioral biases exist, as long as investors are irrational, it will be difficult for you to have an efficient market. On the other hand, if all that is required for markets to be efficient is that investors cannot consistently beat the market on a risk-adjusted basis, then the evidence does support market efficiency. Now, what are they saying? The fact that people find it very difficult to beat the market, it is already a simple evidence to show that what markets are efficient. Because if markets are not efficient, everybody will be beating the market. Yeah. And with these few points of mine, I have come to the end of this reading. And I believe that it is safe to say that we have come to the end of this class. Any questions? Any questions? This class is going to end by 12:30, and I've ended it 30 minutes before. Any questions?
Not from my end.
Temitayo, any questions?
No.
Okay, dokie. Thank you very much, and I will see you guys next week.